But once defaults begin to rise materially, it matters a lot what such a security contains. And with highly nonlinear payoffs, returns can be extremely sensitive to small changes in the underlying conditions. Now, when defaults on some US subprime mortgages originated in 2006 and 2007 started turning out much higher than expected, there was a realization that losses could be much greater on some of these securities than previously believed. And a growing realization of the informational complexity of these securities made them difficult to price in an objective sense. Essentially, investors switched from believing that returns behaved according to a tight and well-behaved distribution to one in which they had very little idea about the likely distribution of returns. In other words, a state of virtual Knightian uncertainty. There was also a higher order information problem arising out of the interconnected nature of the financial system. Banks, when they appear at all in economic models, just exist to transfer funds from savers to borrowers and to monitor the latter. But the reality is a high degree of exposure of financial institutions to each other as a result of interbank loans, holdings of credit default swaps, and securities issued by other parties, and so on. Now, in normal times, one doesn't need to know much about a counterparty's risk exposure. But when there are doubts about the solvency of a major institution, one needs to know not only one's own exposure to that institution, but also about the exposure of one's other counterparties to the major institution in case their solvency is affected too. The collapse of Lehman Brothers was particularly critical as it was viewed as being too big and too interconnected to fail, particularly in the light of the earlier rescue of Bear Stearns. But the inability of the US authorities to put together a viable rescue plan, together with growing doubts about the likely effectiveness of the troubled asset relief program, raised the possibility of a failure of a whole range of institutions that had previously been considered safe. And that's evidenced in the simultaneous sharp spike upwards in financial institutions' credit default swap spreads in the wake of Lehman's collapse. Unfortunately, the line from Lehman's here, which is a sort of light blue, which showed up flying back at the Bank of England, is difficult to see in this chart, but it's just about there. But you can see the credit default swap premium for a range of other banks spiking up around October 08 in the wake of Lehman's collapse. Moreover, the prospect of having to make significant default payouts called into question the solvency of a key provider of that insurance, namely AIG. The bottom line is that the information requirements for managing risk escalated rapidly at the same time as investors woke up to the realization that prospective returns on a range of asset-backed securities were far worse than they thought. Not surprisingly, there was a rush for the exits and a drying up of wholesale funding to vulnerable institutions. Moreover, attempts to cope with that by selling off assets ran into an adverse selection problem. If someone's selling an asset, then perhaps they know it's a lemon. And even the revelation of central bank support in its role as lender of last resort, far from solving the problem, could be interpreted as a negative signal. And that was very much the case with the support line that we provided to Northern Rock in September 2007. As a result, at times such as what now I think needs to be called the little panic of August 2007 and the great panic of September, October 2008, the markets for a whole range of asset-backed securities closed completely and investors sought safety in liquid government assets. And these pressures are reflected in the spread between measures of bank funding costs and equivalent maturity government debt, the so-called TED spread, and that's given by the orange block here, the difference between the 3-month T-bill yield and the 3-month Eurodollar rate. And even when confidence has appeared to be improving, the markets for asset-backed securities have remained pretty dysfunctional. Now, while these incentive distortions and information problems help to explain why the crisis happened, they don't explain why its impact has been so great. Back in early 2007, the US Federal Reserve estimated that the unexpected losses associated with the subprime mortgage market would be of the order of $50 billion. Since then, the IMF have progressively raised their estimate of the write-downs on US-originated assets to $2.7 trillion. And you can see here the gradually rising scale of their estimates of the write-downs. Their current estimate for write-downs across the United States, Europe and Japan stands at $4.1 trillion. And then alongside that, we've witnessed a sharp and internationally synchronized slowdown in global growth, together with an unprecedented contraction in world trade, as shown in this slide. The shortfall in advanced country GDP relative to potential alone is projected by the fund to reach around $2.2 trillion in 2010. So how could this all come about? Well, the first thing to be said is that much more was involved than the imprudent extension of loans to a few poor US households. Rather, the unexpected losses on subprime mortgages acted as a trigger for generalized doubts about the viability of a whole class of assets and a rebound in risk premium. So the fundamental shock here was rather larger. But there are also a number of amplification and propagation mechanisms that appear to have kicked in. Some of these positive feedback loops have operated entirely within the financial sector. The most obvious is that the withdrawal of funding and the need to maintain adequate capital ratios led to fire sales of assets. But if there is great uncertainty about the fundamental value of an asset, or a suspicion that the seller may have chosen to sell it because he knows it's a lemon, then prices are likely to have to fall a long way before buyers are willing to step forward. And that's particularly so if potential buyers are concerned about their own access to funding. But given the use of mark-to-market accounting to value trading books, the falls in asset prices then worsens the balance sheets of other institutions. That in turn reduces their capital ratios, aggravating their problems in raising funds and generating a further round of asset sales. Further amplifying mechanisms arise as a consequence of leveraged positions. The net worth of a leveraged investor deteriorates much faster than his gross worth when asset prices fall, as all of the loss is scored against capital. Thus, even to hold leverage constant requires substantial asset sales, further depressing asset prices. For instance, an investor with $100 million of assets, financed by $10 million of capital and $90 million of debt, who experiences a $5 million loss in asset value, would have to sell $45 million of assets and use them to buy back debt if he wanted to restore his original leverage ratio. In fact, things are even worse than this, because lenders typically expect borrowers to fund a larger fraction of an investment themselves in such circumstances, and that reinforces the downward spiral. Now, I noted earlier that once counterparty risk becomes a material concern, it is not only the state of an intermediary's immediate counterparties' balance sheets that matter, but also the state of those counterparties' balance sheets, and so on. In practice, the pattern of exposures between counterparties forms a highly complex network, which is both difficult to comprehend and a major source of uncertainty. And this complexity of the financial network is going to be illustrated in my next two slides.